Good afternoon, everybody. My name is Russ Mould. I'm the AJ Bell Investment Director. And thank you for attending this webinar, which will be a look ahead to markets in 2019. Just a few details before we start the main presentation, if I may. Firstly, apologies for the slight cold that I've got, which has been donated kindly by one of my fellow commuters on the Brighton to London line. But more importantly, you're welcome to ask questions at any time during the presentation in the questions box within the control panel on the right-hand side. Only we can see them. Please don't be shy, and we'll try and get to as many of them as we possibly can at the end of the presentation. If we don't get to them during the at the end of the presentation, we will try and endeavour to get back to you afterwards. If you have any technical problems, then please just report those in the questions box, and we will send out an email about an hour after the webinar to ask for some feedback, and also we'll give you information as to where you can download today's slides. If you don't get this in about an hour's time, please do check your junk folder just in case, as it may have sneaked into there. This session is being recorded, and we will also make a video available on our website at some point in the next week or two. So we'll just one final point of order before we actually get stuck into the meat of the presentation. Here we have the disclaimers. So please note, as usual, that the value of our investments can go down as well as up, and you may get back less than you originally invested. We don't offer advice, so it's important that you understand the risks involved, and if you are unsure, then please consult a suitably qualified financial advisor. Tax treatment always depends upon your personal individual circumstances, and the rules may change, courtesy of Her Majesty's Revenue and Customs. And past performance is not a guide to future performance, and some investments may need to be held for the long term. So those are the formalities. Let's get into the contents. We're going to quickly whiz through 5 trends that really mattered last year, what that meant, and then 5 trends that may well matter for 2019 and beyond, and perhaps most importantly, how we continue to track them, and then by way of conclusions, what the key issues are that we all need to address, perhaps when it comes to portfolio construction in 2019 and beyond, within the realms of your own personal investment strategies, time horizon, target returns, and appetite for risk. And as ever, appetite for risk in a financial market context is best defined as your ability and willingness to withstand and suffer losses in pursuit of positive total returns. And then we will, at the end, take some questions. So in terms of 5 key trends last year, well, overall, I think it's fair to say that hopes for a globally synchronized economic recovery sagged a little bit as the year went through. The dollar proved strong. Central banks were still, perhaps regrettably, centre stage. Volatility began to increase. And just to go back to a topic that was incredibly hot when we did this webinar a year ago, Bitcoin subsequently collapsed. And that's not, by the way, establish my credentials as a no coiner or anything else, or to poke fun at those who were involved in Bitcoin, but it does raise some interesting issues. So in terms of growth expectations, well, US GDP growth on balance probably surprised on the upside, partly helped by the Trump tax cuts. US GDP growth ripped along at 4.5 to 5% in the middle of the year, though it seems to have cooled a little bit towards year end into the sort of 2 to 3% range, though still not bad, and frankly better than it was probably doing for a good bit of the Obama presidency. But what was interesting, or the question that raised, was how much longer can the US continue to fire on all cylinders when the globe, the rest of the world, probably isn't? And there were clearly concerns over Trump, trade and tariffs and whether there would be a knock to global growth from that. EU numbers began to come in pretty weak towards the end of the year, partially hampered by the diesel emissions scandal, new diesel emissions testing mechanisms, which did dampen car output and car sales. The UK has got the parochial issue of Brexit to address, which I'll try and avoid as best I can for the next 30 odd minutes or so. But nevertheless, overall, generally speaking, growth hopes began to fade, and rather surprisingly, I think to everybody, bonds actually outperformed equities for the year as a whole, even if for most of the year shares did better. Right at the end, share prices sagged, bonds held relatively firm or even rallied, with the result that you get this chart on the right-hand side, which divides the price of an MSCI World Equity Tracker or Exchange Traded Fund by the price of an iShares Global Government Bond Tracker or Exchange Traded Fund. If the line's going up, shares are doing better. If the line's going down, bonds are doing better. And as we can see in the end, bonds actually had the better of the argument. The second trend was the strength of the dollar. Now, this may be related to the dash for bonds. Investors looking for a haven asset during slightly less certain times. And this just looks at the DXY or Dixie trade weighted dollar index. That's the gray line that you can see here. And it slowly advanced throughout the year. It was probably up 5 or 6% over the year, so nothing ridiculous. So nothing compared to, say, the increases we saw in the late 1990s or the mid 1990s, or going further back, the mid 1980s, when this index actually reached around 160 compared to the sort of 95 that it's at now. But traditionally, a strong dollar is seen as a negative for risk assets like stocks and emerging markets. Now, which is the chicken and which is the egg will remain a point of constant debate. But you can see here on this chart, there seems to have been a fairly long-standing inverse correlation between the dollar and emerging market equities. Now, again, past is no guarantee for the future, but that relationship held firm in 2018. As the dollar rose, emerging equities took a bit of a hammering. That's partly because a lot of emerging markets have a lot of overseas debt. And as the dollar goes up and their currencies go down, that makes it more of a burden on their economies to service that debt. Turkey and Argentina in particular being cases in point. The one issue that is worth bearing in mind is that having been a consensus bearish position where people didn't think the dollar would go up at the start of the year, I think it's fair to say that most economists were pretty bullish on the dollar by the end of the year, partly because the Federal Reserve continues to move ahead with interest rate rises, and lo and behold, the dollar has started this year on a bit of a weaker footing. But nevertheless, it was a key influence, I think, last year. I've just mentioned the word central bank, so here we go again. The Federal Reserve was particularly important in 2018. 4 1/4 point rate rises in 2018. That takes the total to 9 since the start of this upcycle in late 2015. It's been a pretty tortoise-like pace, but it's been relatively consistent of late. And if you look at the last 8 bull markets in US equities, it has on average taken 8 to 9 quarter point increases from the Fed to snuff them out. So that's exactly where we are now, though that is an average figure. And I should say that the range is frankly pretty wide. The Bank of England even squeezed out a rate rise, but I think just as importantly, that we began to get the first steps from quantitative easing to quantitative tightening. The European Central Bank ended its QE or stopped adding to its QE program. It didn't end it because it's still got the assets on its balance sheet, the bonds it's bought, but it stopped adding to them in December. The Bank of England's already done so. The Bank of Japan undershot its target of 80 trillion yen a year, and the Federal Reserve actually began to withdraw stimulus by a rate of up to $50 billion a month by the end of the year. So the chart on the right-hand side, the lines, the Fed headline interest rate, the upper band, and the bars in grey, that's the total assets of the US Federal Reserve, all of these government bonds, corporate bonds, and mortgage-backed securities that they've bought. And as you can see, it's just starting to decrease a little bit. I think the Fed's balance sheet's now about 12% smaller than it was at the start, or at its peak, I should say. And this is a key test for the bull run. Because if you've been of the view, and lots of people are, that most financial markets, stocks, bonds, to a degree commodities, property, residential or commercial, and other assets like vintage cars, wine, art, you name it, have bathed in a tidal wave of cheap liquidity, at least $12 trillion provided by central banks in a conscious attempt to try and get asset prices up and create a wealth effect. If that $12 trillion is now going to start slowly leaking away, does it mean it's going to be harder or even negative for financial prices from here? And we're going to find out. But it may or may not be a coincidence that as the Fed has begun to withdraw those assets, stock markets have got choppier. Now, here's the choppiness. Volatility, not a word that we used terribly much in 2017, but certainly began to make a bit of a comeback in 2018. We saw the VIX, the fear indices, jump once or twice in the US and indeed in the UK. And the final quarter of the year showed some particularly wild price swings. Now, this chart on the right, on both sides of the Atlantic, this chart on the right-hand side just looks at the number of daily movements open to close of 1% or more in the FTSE 100. And as we can see, bull markets like 2004, 5, 6, and 7 tend to be characterized by relatively low volatility, serene progress, which then begins to get more wild and more volatile as doubts about the bull market begin to creep in, reaching a final crescendo of panic in, say, 2008. What we've now had for the last 2 or 3 years, Perhaps with everybody drugged by central bank cheap cash, markets have been generally pretty docile, 2017 particularly, and now volatility is just picking up as some of that money is withdrawn. It certainly does not mean we've necessarily reached the end of the bull market in stocks, but it may mean if, and it's a big if, we're following the pattern of 97 to 2000 or 98 to 00 or 2005 to 7, that as things get choppier, markets might just start to find it harder. And clearly, perhaps a big trigger for getting really interested again will be when actually everybody's running around like headless chickens, as they were in 2002, 3, and 2008 to 9. Because as you can see here, the worst performances coincided when panic was at its highest. And this is where the moral of the tale of Bitcoin comes in. Risk appetite does seem to have been checked by this withdrawal of central bank liquidity and US interest rate increases. The old mantra for assets was that other than cash was TINA. There is no alternative. And that was particularly the bull case for stocks. You weren't getting a yield on cash. You weren't getting a yield on bonds. You were getting a yield on equities. And you were seeing capital gains in pretty much anything that you could lay your hands on, including cryptocurrencies. However, once US Treasury yields reached 3%, for example, that perhaps there was an alternative to equities. 3% in the US reserve currency, the dollar, which was in itself going up, may have started to give some investors some pause for thought. And the TINA, there is no alternative argument, didn't look quite as strong as it had done. And as risk appetite began to wobble a little bit in the face of safer alternatives, potentially, you saw in a classic late cycle movement, risk appetite begin to ebb, and certain peripheral markets where people perhaps felt they had to get involved, either because things looked like they were exciting or they're being pushed beyond their normal risk tolerance to try and get a gain, they began to wobble. Bitcoin topped out actually just before Christmas 2017, but the crash set in Q1 2018 and it's just kept on crashing. Low volatility strategies came unstuck in late Q1, early Q2. Emerging markets took a duffing in Q3. And then the tech FANG stocks, Facebook, Apple, Amazon, Netflix, and Google parent Alphabet, they all took a drumming in the fourth quarter. So that loss of risk appetite, you began to see moving up from the periphery nearer to core assets. And in many ways, US equities were almost the last person standing, though even they began to crack in the fourth quarter as well. In fact, the only assets that actually, from memory, provided a positive total return in sterling terms in 2018 were German bonds and gold, neither of which could be held up as risk assets because they're both generally seen as havens. Now, again, this is not to say it's game over, because we still don't know what central banks are going to do. They may well recant, but it certainly suggests that it was a tricky 2018 turned out to be a tricky year than many people expected. And this is the bit I'm particularly good at. This is telling you what's happened. So these are the total returns in local currency in grey, sterling in red. And again, the pound's weakness, because of worries over Brexit, the UK economy, meant that holding overseas assets was on balance a helpful strategy in 2018, even as we all know, second guessing the currency markets is the devil's work. The FANGs, despite the hammering they took in the fourth quarter, still generated positive total returns. As you can see, pretty much everywhere else was tough going. Developed market equities were hard work. Global equities were tricky. Gold, as you can see, was positive in sterling terms. But overall, pretty much anywhere you looked, it was hard to make money, which on the face of it makes it feel like if it is still a bull market, then it's a pretty funny one. Looking at it in equity terms, again, in sterling terms, we managed to intriguingly squeeze out a gain from Eastern European equities, which I doubt anybody would have guessed given oil volatility and Russia still being in the diplomatic doghouse last year. America ended up down in local currency, small total return positive in sterling. Everything else, no joy at all. And the biggest shocker perhaps was actually Asia taking a real hammering. Perhaps their emerging market concerns a key factor with Asia possibly thrown out, the baby thrown out with the Turkish and Argentinian bathwater. The UK, middle of the pack, but it didn't do anybody too much good last year. From equity sectors, again, everybody began the year getting really excited about global economic growth. Look at the right-hand side, the worst performers include industrials, materials, and financials, all cyclical sectors, so that didn't work out so well. Actually, the sectors that did best were healthcare and utilities, relatively defensive plodders to show how risk aversion gathered during the year. And then bonds, well, some bonds generated positive total returns, but even then not many, with German bonds pretty much top of the pack. which again would hardly suggest that the world is bristling with optimism right now, though that, of course, could in itself be an opportunity, as we'll discuss later. So that's what's got us where we are. That's the easy bit. Unfortunately, this is the hard bit: is working out what's potentially coming next. And some of these themes sort of overrun from last year, but they're all here. Central banks, interest rates, and QT. This quantitative tightening, this withdrawing of stimulus. Trump trade and tariffs, the yield curve, banks, and I'm afraid to say I had to mention it, Brexit. And we will just look at how we can, quickly take a quick and easy check as to what these trends are meaning for portfolios, and do it without paying fortunes or hopefully anything for financial data. So central banks, rates and QT. So the Bank of England and the European Central Bank have stopped adding. The Bank of Japan is undershooting by about half, and the central bank, the Fed, the key central bank of all, is still talking about withdrawing rate QE at $50 billion a month maximum. Now, the Fed is maybe talking about opposing interest rate increases, but it still seems to have set quantitative tightening on autopilot. And such is the size of the Fed's withdrawal that the big five central banks, if you chuck in the Swiss, their balance sheets are actually going to start shrinking year on year in dollar terms from about now. This chart on the right-hand side shows the year-on-year growth in aggregate dollars across the big five and just runs it against the year-on-year change in the FTSE All-World Index. Not a perfect correlation by any means, because life's just not that easy, but it does show that as liquidity is drained away, it's got harder. So this is a trend that we need to watch. It'll be interesting to see if President Trump starts pressuring the Fed on QT. He isn't doing it yet. Markets are pushing back on interest rates, but it's QT, if anything, is calling the tune right now. So watch out. Fed first meeting at the end of this month. We've got the Bank of Japan and the European Central Bank actually next week. Let's see what they say. But this is an underestimated theme still, in my opinion. Everybody's banging on about interest rates. It's actually balance sheets and asset buying that matters, and this liquidity slowly being withdrawn. It's a key feature. Trump trade and tariffs. There were promises made at the G20 meeting summit in Buenos Aires in November. Nothing's come of those yet. And we're moving towards the 2nd of March deadline when America, the 90-day hiatus after Argentina will come to an end. And America may increase tariffs from 10 to 25% on the products it's already stuck them on. And then, frankly, stick them on the remaining Chinese imports of around another $250 billion. Now, that's going to include smartphones, laptops. Now, Apple shareholders aren't going to enjoy that at all, because let's face it, the company's got a few challenges as it is, and that may well make President Trump think. Equally, America's trade deficit with China went up again last year. President Trump isn't going to like that either. Now, lots of commentators were assuming that Trump would take a softer line after the midterm elections for political reasons. The economic data would suggest he's not got an opportunity to do so, and he frankly doesn't seem inclined to do so right now. So we're all still on tenterhooks. Trump still believes that somebody can win a trade war. Who are we to disagree? Well, history books don't look so smart in that respect. History suggests nobody wins a trade war, and Smoot Hawley's introduction in 1931 in America made what was an already difficult situation an awful lot worse, and global trade volumes suffered as a result. So we are still all on tenterhooks. How do you actually try and encapsulate this in maybe one simple chart? Well, life's not that easy, but one thing that I do look at is the SOX index, the Philadelphia Semiconductor Index. You can follow it on Yahoo, on Google for free. Why? Well, the silicon chip industry globally is a $400 billion business right now, there or thereabouts. And silicon chips are in everything from your laptops to your smartphones to your cars to your fridge to whatever it happens to be. They're in pretty much everything. So they're a great proxy for global economic growth. And chip stocks are beloved of momentum jockeys. They feed off earnings upgrades and they swerve earnings downgrades. And as you can see, the SOX peaked last March. And if you look at the SOX index over the last 2 bull cycles, it peaked about 6 to 9 months before the NASDAQ and the wider US indices did. So it's kind of missed the market's way of doing a bit of a scratch and sniff test. As you can see, the SOX on the right-hand side has had a big rally to start off this year. Let's see if that continues. If it does, that's potentially positive. But if we start getting more profit warnings from chip stocks, and Micron coughed up a big one just before Christmas in December, and Apple, one of the world's biggest silicon chip buyers, just coughed up a profit warning after Christmas, that's potentially troubling. But the SOX index could be a good proxy for the Trump trade tariff theme. A rally here will be potentially good news. Further weakness will be potentially troubling, if history is any guide. The yield curve. All sorts of people bang on about the yield curve, and I don't like it particularly. But again, it's a bit of a quick and dirty proxy for sentiment on economics. It's not a perfect indicator. It does give out false signals, and it's certainly possibly been distorted by QE, with central banks trying to depress interest rates by buying all these bonds. But again, that distortion may now begin to ebb if QT starts to kick in. But generally, a flattening or inverted yield curve can warn of a recession, whereas a steepening can foretell of growth. Why? Well, this curve on the right-hand side looks at the yield on the US 2-year interest rate, or US 2-year Treasury, and the US 10-year Treasury. In general, you as an investor will very shrewdly demand a higher interest rate or coupon from the 10-year bond than a 2-year, simply because more things can go wrong in the interim. There's an extra 8 years of things that can go wrong. Now, generally, from a bond investor's perspective, that's default. Well, we're not expecting that from the US. It's interest rate risk, which is, let's face it, rates are going up right now, and it's inflation risk. There, your three big risks, and a lot can happen in 2 years, and an awful lot more can happen in 10. So generally, the longer dated the bond, the higher interest rate or coupon you will be demanding to compensate for the risks involved. So what's this yield curve telling us right now? Well, right now, it's telling us that the market is pricing in short-term rate increases through the 2-year, but it's then saying the Fed is going to recant and change its mind and start cutting interest rates further out. And that's why as the 2-year rate was rising, the 10-year rate was coming down, the flattening of the yield curve. It's not inverted. The 10-year yield is still above the 2-year yield, but certainly it's got pretty low by historic standards, and that's why people are worried about a US slowdown. There's no big sign of it macro-wise right now, 2 to 3% for Q4 growth is expected, but household sales have begun to flatten out. Auto sales have begun to flatten out. We've got tariffs to think about. Exports to China have certainly been weaker. And we've now got the additional complication of the US government shutdown. So keep watching this. It is a quick and cheap proxy. It's not always right, but lots and lots of your fellow investors are looking at it. Keep your eye on it, because if the US does turn turtle and slow down, then in fairness, we probably do have a pretty big problem for 2019 and beyond stock market-wise. Banks. Now, can't live with them, can't live without them is probably a pretty good way of looking at it. And after the crisis of 2007 to 9, it's nice to think that the banks are in good health. Now, the US, European, and UK financial stress tests all generally give the banks a clean bill of health. But below me, this chart on the right-hand side shows the S&P Global 1200 Banks Index and the FTSE All-Share Banks Index. Equities, not good. Somebody somewhere was not happy at all last year. The good news is they've actually rallied a little bit this year. The good news is that the US banks, Citi, JP Morgan, have put up some decent fourth quarter earnings forecasts. But Italy's just bailed out Banco Carige. I think it's 10th biggest bank. That's the fourth bank bailout in 2 years, which doesn't say much for the ECB stress tests. And overall, they just were horrible last year. Whether somebody's worried about the economy, whether somebody's worried about something hiding in the global financial plumbing, we don't know. But it would be nice to see these stocks do better in 2019 to give us confidence that the bull run isn't over, that the withdrawal of liquidity isn't a problem, and that the economy is still capable of generating some decent growth. So the last trend to watch, nobody knows what's happening, least of all those in Westminster. So there's very little value perhaps we can add. We know that the market is currently using sterling as its lightning conductor because gilts, well, the Bank of England still sat on £435 billion worth of UK government bonds. So that market, you could argue, is being slightly distorted. Stocks are probably taking their lead from sterling. Right now, sterling is holding firm at about 128, even after the dishing that Theresa May took last night. Economists say that in the event of a hard Brexit and economic shock, the pound could go to parity against the dollar. If things go better than expected and the economy holds up more than people think, it could go back to 150 where it came from against the dollar pre-referendum. In which case, if the range is 1 to 150, sterling holding in the 125 to 128 range tells you that nobody knows, right? Because if Westminster doesn't know, we certainly don't know. And as the economist Robert Solau once said, economists are often asked for their predictions about the economy, but to make predictions about the economy, you need to make predictions about what politicians are going to do, and nothing is more unpredictable. And I think that's the view that's holding with UK assets right now. That's why sterling is where it is. Gilts with a yield down at 1.26. That suggests there's demand for haven assets. There's not yet fear of a Corbyn government. Rightly or wrongly, depending on your political viewpoint, markets don't seem too keen on the Corbyn-McDonald administration. They fear higher government spending. They fear privatization of public assets. These are things that markets don't like. Philosophically and politically, you may approve, but financially, they're not necessarily seen as helpful right now. But gilts, not yet worrying about a change in administration. Sterling stuck in the middle of nowhere, people wondering one way or the other. And the result, the FTSE 100, well, it's below its 1999 peak, and it's just a matter of fact that it's been a serial underperformer of other geographic options since the June 2016 referendum vote. The net result of all of this gloom, pessimism, confusion, call it what you like, is that UK stocks are cheap and they're unloved because there's been nothing but fund outflow since June 2016. On a forward earnings basis, you can say that UK stocks are cheap on 11 times, though obviously the risk is the earnings forecasts are wrong if a recession hits. On a dividend yield basis, the premium yield you're getting relative to the bond market, the 10-year gilt yield, is enormous. It's over 2%. In fact, it's nearer 3%. So if the dividend forecasts are any good, and there's a clear caveat there because that relies on the earnings forecast being any good, UK stocks are cheap. Your problem is what's going to make people think that they don't deserve to be cheap when we don't know what's going on in Westminster. We don't know what Brexit will or not mean for the economy. And that is why at the moment UK stock seems to be in a holding pattern. But there is, certainly it's easy to argue that they're cheap. It's harder in the short term, at least, to argue that they don't deserve to be. But at some stage, if and when we ever get any visibility on Brexit, at least we can then make a rational decision on earnings forecasts and yield forecast, dividend forecasts, whether they're sensible or not. And that will give us a chance to really decide whether UK stocks are cheap or not. But there's no doubt about it. Pessimism is everywhere, and they are seriously unloved, which is potentially quite interesting. In the end, there was an article in the Financial Times before Christmas when a fund manager was quoted as describing UK equities as uninvestable. To me, uninvestable sounds pretty close to unsinkable, which we know that didn't do much good for the Titanic. So going with that sort of consensus is generally not necessarily the best thing to do. So this comes back to a quote that we did at this time last year. Sir John Templeton, he died a billionaire, so he's well worth listening to, always still worth listening to. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. No shortage of euphoria about Bitcoin at this time last year. Didn't do anybody any good. No shortage of positive optimism last year on global economic recovery, US equities, FANG stocks. Didn't do anybody any good. So we've got to be careful. Admittedly, pessimism going against the crowd didn't do you a fat lot of good either because the UK is still underperformed. But following the euphoria and the optimism got you into a lot more trouble. So this is just my quick rule of thumb based on questions I get from customers, based on what I read in the newspapers, based on broking research, based on share price, on asset price performance, and above all, based on valuation, as to where I just think you currently can see pessimism, skepticism, optimism, and euphoria. How do you deal with that is according to you. But over a long time, you would suspect that if Mr. Templeton's metric holds true, aphorism holds true, you might want to be doing your research on where people are pessimistic and being a little bit more wary of people who are euphoric. Now, the good news is, if anything, finding euphoria is pretty hard right now. So I actually have to take that as a bit of a positive. There were no shortage of chest-beating topics last year, but right now, not so many. Pessimism, UK equities and sterling, right in the doghouse. Real estate stocks and physical retailers, right in the dog. Now, this may be perfectly fair. There may be structural, genuine reasons why these things are never going to come back. But at least you need to think about it. European equities have done very badly. Cryptocurrencies, yeah, we've gone from penthouse to outhouse over the last 12 months. And value investing is still pretty tough sledding. Skepticism, emerging markets, particularly China. China's down on a P of about 7. If you believe the earnings forecast. Gold, nobody interested except the gold miners themselves. 2 big gold mega mergers recently, Randgold and Barrick, Newmont and Goldcorp. Investors may not think that there's value in gold mining stocks. Gold mining executives do. May be worth thinking about. Banks we've just seen, nobody's interested. Japanese stocks have taken a pasting as people lose faith in Abenomics. And income investors finding it tough. Income funds have generally struggled over the last 12 or 18 months. Because yes, the income's been paid, but the capital suffered on the grounds that people have been getting worried over the dividends. Optimism. I still think people are optimistic about FANG stocks. Netflix is up 30% this year. That sounds pretty optimistic to me for a company that has got a lot of debt, doesn't generate any cash. And overall, those stocks still look very expensive on traditional valuation metrics, as do US equities. People are optimistic on the dollar, which needs bearing in mind. Oil's had a bounce. Healthcare stocks, there's a lot of optimism, a lot of merger and acquisition activity there. And Momo and growth are still the prevailing strategies followed by a lot of people. rather than value and income. I'm not saying it's right. I'm not saying it's wrong. I'm just saying that that's been a long-running game for a long time. And we all know there are a few better strategies in Momo when it works and a few worse ones when it doesn't. Because when the Mo's not there, the valuation doesn't give you support. And you can see that last year with Snap, with the FANG stocks, and one or two other companies where earnings just didn't quite come up to expectations and they got absolutely mashed as a result. Euphoria. The only thing where people are still probably getting excited, really, apart from residential property, is index proliferation. And I say that with regard to things like exchange-traded funds. We like exchange-traded funds as a potential portfolio tool. They're cheap, they provide diversification, they can be liquid under normal market circumstances. But you still have to follow the right asset class. And I think there was a thing I saw at the corner of my eye from Morningstar the other day, that 70 or 80% of sort of themed ETFs that were launched in 2012 don't trade now because they turn out to be bad ideas. So, you know, you're interested in the theme, I can guarantee you somebody will fabricate a product to enable you to play it. But just because they've got names Facebook, Amazon, Apple, Netflix, Google doesn't mean that they're homogenous, doesn't mean that they fit together, doesn't mean that's necessarily a brilliant theme on its own. So the fact that there are more indices and there are individual stocks, I would suspect is something that we need to be careful about when thinking about thematic investing. Yes, look for low. Yes, keep your costs low. Yes, don't turn your portfolio over. Yes, look for diversification if you're unsure. All good points. But you've still got to pick the right basket to follow, the right stocks to follow through a tracker. And some of these things are pretty here today, gone tomorrow. So again, avoid the euphoria. Whether you want to get involved in the hard work of digging through pessimism is another one, but certainly following the crowd can get you into trouble sometimes. So what is another smart investor doing? If Mr. Templeton was, Sir John was Templeton was one, not everybody likes Warren Buffett, but I think, again, his record stands very close inspection over a very, very long period of time. And this just looks at the asset allocation of Berkshire Hathaway. Now, it doesn't add up to 100 because the other bits are his insurance and his industrial assets. But what gets people's attention is the black line, because Buffett's running a near record high cash position at just north of $100 billion, which would suggest Mr. Buffett, a value investor, is finding it very hard to find value right now. As he said, I'm struggling to make a really big acquisition because I can't find anything I like at a price that I like. That is in itself something we should bear in mind, particularly when we're just coming out of a year when merger and acquisition activity was extremely high. So executives may think that there's something to be done, but they're probably growth obsessed. Value investors, less keen. But what really catches my eye here is the red line. This is Mr. Buffett's allocation to bonds, fixed income, and it's basically at a record low. Now, at a time when the markets are probably all worrying about growth, this would suggest that Mr. Buffett thinks that bonds are not particularly good value with the low yields that they're offering, and that if inflation comes around the door, then they're particularly bad value. So Buffett's not necessarily a habitual contrarian, but he certainly doesn't believe in following the crowd blindly, quite the opposite. And so it's just intriguing to me that at a time when we're all a little bit worried about, recession or slowdown or even deflation, he's worried about inflation. So if you're looking for a contrarian call, maybe that's one just to bear in mind. So thank you very much for your time, everybody. I really appreciate it, and I hope that was useful. I appreciate it was a massive whirlwind tour in about 35 minutes. But hopefully it's given you some food for thought, and, well, touch wood it has, because we've got some questions coming through. So I will try and blaze through as many of these as I can, as quickly as I can, and ones that we don't get back to you, we'll try and reply to separately afterwards. Will I be covering how an investor in funds, the majority is listed in US stocks, can hedge the pound? Well, I didn't. Again, the tricky, as we know, the pound last year was a benefit. It's gone up a little bit this year, so it's actually negative if you're holding overseas assets. Second guessing currencies is extremely hard. It's a wildly liquid market, but a very, very unpredictable one. You can hedge. You can buy currency hedged funds, but you do pay for the privilege of doing so. So there are options out there, but generally the total expense ratio, the cost of ownership, is more expensive. You can do it. You can get a fund manager to do it for you rather than doing it yourself, which is probably simpler, but it will cost you. So it can be done. Do CAPE and other indicators taken together suggest the best country regions? Now, at our annual financial advisor conference 2 or 3 years ago, Neil Woodford said he doesn't look at CAPE at all. And he basically kicked it straight into the rubbish bin. CAPE, cyclically adjusted price earnings ratio, developed by Professor Robert Schiller, Doesn't look at forward earnings forecasts on the grounds that they're generally wrong, and I should know that because I was an investment analyst for 12 years. Nobody's got a crystal ball. So what Schiller does is he takes a rolling historic 10-year average and adjusts for inflation. On that cyclically adjusted price earnings ratio, US stocks have only been more expensive twice in their history, 1929 and 2000, and neither of those ended well. But CAPE is not a timing tool because it's been flashing danger for 5 or 6 years, and it's not stopped your equities going up. What it probably tells you is that if anything goes wrong, you've got very little downside protection. So that's, again, a matter of how you deal with that in terms of your own target returns, particularly time horizon and appetite for risk. But I think if you look at some long-standing issues like metrics like price to book, Asia and emerging markets look cheap. You look at yield, the UK looks cheap. You look at earnings, Europe's not bad. So that's where the value is. But in the moment, what you're doing is you're looking for catalysts, and I admit that they're probably hard to find. But again, applying the Templeton metric, where there is pessimism, there is generally low valuations. You can have good news and cheap stocks. You just can't have both at the same time. So if you do your research, find companies that are well-funded, well-run, look cheap over a cycle average of earnings, you're probably onto something in the long term. It might not stop you, losing money, potentially suffering book losses in the short term, but they're only real losses if you sell and crystallize. Over time, good companies with high margins, strong cash flow that pay growing dividends should, if history's any guide, work out for the best. CAPE at the moment would raise questions over the US and would perhaps suggest on a 5 or 10 year view, the US is going to find it hard to generate positive capital returns. You may get some total returns through dividends, but again, it could be harder. Since the market crashed by almost 20%, are we in a bear market? That is the mathematical definition. That's a really good question. And some things did go down by 20% and more. The FANG stocks, for example. So in some assets, you can argue technically are in bear market mode. Lots more are in correction mode of 10% or more. And as I said, if we are still in a bull market, it was a pretty funny one last year when most things in local currency terms didn't beat cash. Most things in local currency terms didn't generate positive total returns. Sterling's weakness helped those of us out who were based here in the United Kingdom. How can I follow what Berkshire Hathaway are doing? It's a really good question. BerkshireHathaway.com, and you can look at their quarterly accounts, and they show you what they own in cash, what their industrial assets are, and what their bond holdings are. You can also, if you want to get really technical, go to the EDGAR database in the United States, which is run by the SEC, the Securities and Exchange Commission, and you can look at what are known as 13F filings. Now, from memory, 10K filings are annual, 10Q filings are quarterly. 13Fs, they show major changes in shareholdings. They're published with a lag of about, I think, up to 90 days. But if you want to invest like Buffett invests and look at the things that he owns, every time he changes a major shareholding, he has to file a 13F, and you can actually track that yourself, and you can do it for free. Doesn't cost you anything. You just have to keep an eye on just go Berkshire Hathaway 13F or Berkshire Hathaway SEC or Berkshire Hathaway EDGAR, and you'll be able to track them. Other than that, look at the annual reports and the quarterly reports, and the next one from Berkshire is probably due late February, and that's the one that contains Buffett's letter to shareholders, which is pretty much his view of the state of the world right now. And whether you agree with them or not, it's always educational. I've been doing this for 28 years. I learn something from every page each and every year. Where can you see inverted yield curves so you can monitor them? You might be able to find them on for free for a certain number of times on say a Bloomberg page. But if you Google US 10-year yield, US 2-year yield, they'll come up. You can just keep a little track yourself of what they are each day. If all of your assets are already in sterling, how do you invest further in sterling weakness? Well, other than actually openly punting the foreign exchange market, which again I would counsel against unless you have potentially very strong nerves and very deep pockets and basically day trading and sat on top of this stuff all the time, because they're the things that you need to be a successful foreign exchange trader. There's probably not much more you can do in terms of if you other than putting some assets overseas. So not just directly investing in sterling against or selling sterling against other currencies. If it's your view the pound's going to go down, then holding some overseas assets would give you some degree of hedge. Now, you could do that through stocks or bonds or whatever, but again, don't just hold overseas assets on the currency view, because nobody's got a divine right to getting currencies right. You need to invest in things that you think in their own right are attractive assets, and they come with a fit for your personal investment strategy, time horizon, appetite for risk, and target returns. Doing something just for the currency is fraught with risk. If you think US equities are good and cheap and you found the right companies, great, do it. And if as a result of that you get a natural hedge against sterling weakness, that I would view as a bonus. But that should not just buying US because you think the pound's going to go down. I think you need to be a little bit careful, because it's very, very, it's basically impossible in my view to forecast currencies. And I would say to you right now, my forecasting record for currencies is shocking. And when I get asked on live TV and live radio, what do I think? That's the first thing I say. My record is rubbish. And as soon as I'll say something, most people will go and do the direct opposite. How would I advise structuring investment portfolios in 2019? Again, we don't give advice, but what I would say is, again, you need to think in terms of, again, your own strategy, your own time horizons, your own target returns, and your own appetite for risk. And if you've done things that you feel are beyond your normal risk parameters, whether it's an extreme example, something that somebody told you that they fancied when they're in the pub one night, or something that you've had a bit of a punt at, I think they're the things that now you need to be looking at particularly closely. I think we're possibly at the stage of the cycle where we need to manage risk, calibrate risk. Taking risk, you can't get a return without taking risk. But equally, taking lots of risk does not guarantee you high returns. And when things can go wrong, it can actually lead you into some quite deep waters. So what I would suggest is, if you've done things, you're looking at your portfolio or asset allocation, and you've got things that you think, actually, I normally wouldn't have done that, but I did it because I was getting no return on cash in the bank, I was getting no return from bonds, and I've gone beyond what I would normally feel comfortable with. They're the things I would be reviewing, because they're the things that are going to keep you awake at night if things start to go wrong. They're the things that, if they start to go wrong, are going to potentially start leaving you looking at paper losses. Then again, it's how can you tolerate those? With a diversified portfolio, if you don't need the money in the next 2 or 3 years, you can come through, you can sit it out. If your circumstances dictate you may need some liquidity or some cash in the next 2 or 3 years, they're the assets that maybe you should be reviewing. Because again, if you've gone beyond your normal risk threshold to get a return, that's possibly where you're most exposed, possibly where you'll feel most uncomfortable if things start to go wrong. What would I see as signals we've started a new economic cycle? I think that's a great question. I think that looking at it from a macro perspective, I would look at things like purchasing managers indices. You can follow those for free on tradingeconomics.com, or indeed, just through the newspapers or through the calendar on forexfactory.com. So look at the PMIs, look at things like retail sales, industrial production. I would say that PMIs are probably lead indicators. Industrial production, manufacturing output, probably concurrent indicators. Unemployment is interesting, but it's a lagging indicator. Just think of how long it takes for a company to feel confident enough to go to hire people and then go through the tedious process of finding the right person. It's not, everybody, it's got to be done well. It can't be rushed. Put out the advertisement, read the CVs, interview the candidates, make them an offer, haggle with them if they start messing you around. It takes time. So unemployment and employment are lagging indicators. Wage growth, I think, will be important. Then you need to look at interest rates. In terms of stock market or financial market indicators, look at Dr. Copper, so nicknamed because he or she is a good guy to global economic health. I would look at the Philadelphia Semiconductor Index, I think, and I would look at the banks indices as 3 stock market angles on the global economy. If they're all pointing up, happy days. If they're all pointing down consistently, we might need to be careful. What are the prospects for gold in 2019? Well, I can tell you one thing. I've hardly had a question about it for 12 months. That's quite interesting. So the fact that nobody's interested tells me that I should inherently be paying more attention than the average. The fact that you've had 2 major M&A deals in gold, Randgold, Barrick, Newmont Gold Corp, is interesting. Gold went up 7% in the second half of last year, while global equities went down 12%. So it served its purpose as a haven. Interestingly, if you look at the gold chart, it's had 5 or 6 attempts to get through $1,350 an ounce over the last 3 or 4 years. Failed every time. If you're a chartist, and I'm not, but if you're with gold, you've almost got no choice because it doesn't generate any cash. If you're a chartist, if gold gets through 1350, the technicals, boys and girls, will be all over it like a rash, saying that's a chart breakout. If it fails to beat 1350, it'll be back in its basket. If you think gold is a runner as a haven, the other thing to look at is that gold mining stocks have massively underperformed gold itself over the last 4 or 5 years. And dividing the Hui Gold Bugs Index in America by the gold price gets you a historic low gold mining to gold price ratio. If you think gold is a runner, gold miners are a leverage play on that, and they're probably the cheaper way of going about it. They also generate cash when things go well, which gold itself doesn't, because gold is just this inert physical brick. So if you think gold is a haven, gold miners might be worth looking at. But again, they're fiendishly difficult to get right. You need to look at where they operate, what regulatory risk there is, what risk of weather-related problems or logistics problems there are, what risk there is of resource nationalism. Is management competent? Is the balance sheet okay? You know, Goldcorp is trading at multi-year lows because it saddled itself with loads of debt and has got too many projects on the go. That's potentially why Newmont thinks it's getting a bargain. But so you can get gold right and still get the wrong gold miner. So maybe looking at a basket of miners or a tracker might be an option for you if you're looking to mitigate risk there. Is it worth considering the inevitable breakup of the euro? I know my good friend Michael Hewson at CMC Markets, he thinks the euro is toast. And he says we shouldn't worry about Brexit because in 10 years' time, the Eurozone is going to slowly fragment. And that is his view. And I know lots of people who share it. The euro, and there's a brilliant article on it from Martin Wolf in today's Financial Times. It's a flawed construct. There's no fiscal union. There's no banking union. There's no ultimate political union. If anything, the euro is a political construct, but that's why I think they'll keep changing the rules to make sure that it sticks around. The political determination is there. And you've got to think about this from a European perspective. There was a great Radio 4 program last year on Jean-Claude Juncker. He's the son of a family who remember living in an occupied country. And it's something that we in Britain must never underestimate, is that is a race memory that's going to last for an awfully long time. Britain lived in the fear of invasion, but wasn't invaded. Lots of European countries were. And the European Economic, or the European Coal, Steel and Iron Ore Pact, the European Union has its origins in a couple of things. Economic prosperity is one, where you can argue its record is questionable, particularly if you're a young Greek or Italian or Spaniard or Portuguese person, because youth unemployment there is appalling. So the European Union's target of prosperity is you can question it for sure. But what you can say is its other goal was to keep the peace. And I think for 74 years, it's pretty much done that, unless you look at the Yugoslav civil war, and that wasn't part of the Eurozone at the time anyway. But Juncker will be looking at it very clearly through the prism of the peace and prosperity angle. And peace, it's a key driver. And we mustn't forget that here in Britain. And I think that's why they will keep bending the rules to make sure that this stays together, because it has so far kept the peace. And so I think in that respect, the inevitable breakup of the euro, I can see the economic arguments for it. I'm not sure the political arguments are that strong, and politics may actually triumph. Now, what you think that means for your view of Brexit, I will leave entirely up to you. The established gold miners, well, the two biggest in the world after these recent deals are now Newmont Mining and Barrick Gold. The UK used to have Randgold in the FTSE 100. That's now gone. You've got Centamin in the FTSE 250, Acacia in the FTSE 250, and the big silver miners, Hochschild and Fresnillo's FTSE 100, Hochschild is 250. They produce gold as well. But again, that's something that you need to make sure fits your own personal strategies and time horizon, long-term and needs, financial needs and appetite for risk. But those are the names that you could research if you think this is something that may work for your particular financial requirements. And there are funds that focus on gold. BlackRock Gold in General, run by Evie Hambro, the most famous one. There are some investment trusts, and there are some exchange-traded funds that follow baskets of gold miners as well. If UK equities are cheap, could there be an increase in merger and acquisitions by overseas companies? What a lovely, smart question. Funny enough, I actually think you saw that last year. Think about it. Sky was taken over by Comcast of America. Shire's just been taken over by Takeda of Japan. There was a bid for Smurfit Kappa from an American company. So Brammer was taken over by I think a German company. Clepierre of France bid for Hammerson, the real estate company in the UK. So I actually think overseas buyers are looking at UK assets. Yes, in the view that They're potentially cheap and downtrodden, and you may be getting a cheap currency chucked in for good measure. Equally, they've possibly held back a little bit recently because Brexit isn't proceeding. We're only 72 days away. And there is this scenario whereby you could get no deal and sterling goes towards 1 to the dollar. So under those circumstances, if you're an overseas buyer, you might be holding off. But I think if the pound goes down and the UK stock market keeps going nowhere, yeah, for sure, any whiff of certainty on what Brexit may mean, good, bad, or indifferent, I would not be surprised to see overseas buyers coming in for UK assets. And if they do, that is something that we should ourselves consider as investors. Because in the end, if you're an investor buying shares in a company, as Buffett said, we should always think in terms of not just owning shares, fractional ownership, but owning the whole company. If you did not want to own and run the whole company yourself, why would you want to own a share in it? Well, you wouldn't. There's no point buying it just because you think that you might make 10%. You want to own it because you think it's a fundamentally well-run company that's going to provide good returns for the very long term. So thinking in those terms is a good discipline. Thinking in those terms, thinking like an industrialist is a good discipline. It may help you find companies that are undervalued. It may help you avoid ones that are overvalued, in your opinion, and it may help you think about companies that are well run, have a strong competitive position, good management, good balance sheet, and come at a fair price, because they over time have historically been the best returners for individuals. For those of you who do individual stocks, now lots of you won't because you don't have time, don't think you have the expertise, or simply can't be bothered. And then obviously the trade-off is, for your time, the exchanges you pay a fee to a fund manager or you pay a fee to a tracker because they will do the research and the donkey work for you. And again, it's a matter of which you think is best for your particular circumstances. Bond funds. I must say, I'm not a massive expert there. Kev Doran is more of an expert on bonds and bond funds, and our fund team as well, Ryan Hughes and Simon Molliker. It depends on what your worldview is. If you think inflation's coming, then bond funds are frankly going to be pretty tough work, full stop. What you would then be looking for certainly is a dynamic bond fund that is not married to one particular type of bond. Most bond funds specialize in a certain area: UK government bonds, corporate bonds, long-dated bonds, short-dated bonds. That all depends on your worldview. If you think inflation's coming and a rapid economic recovery is coming, you'll probably be looking to keep your bond exposure to a relative historic minimum, knowing that you'll still get the coupons coming in. If you think there's deflationary recession coming, you might think, frankly, that a US Treasury bond fund where you're getting 2.6% from a US 10-year is like finding money in the street. If you think there's a strong upturn coming, junk bonds and high yield bonds might be interesting. If you think a recession's coming, you won't want to be anywhere near junk bonds. So it's entirely up to you and what you think fits with your worldview and your particular financial needs. Bonds will always serve a purpose of providing steady income, but what you must remember, providing, of course, the coupons aren't cut, there's not a default. But what you must remember with bond funds rather than individual bonds is that they have no maturity date. So their prices will move up and down. So yes, you'll be getting the income, but you need to be aware of the capital changes that will result from a bond fund's changes in price. So that's what you always must guide against. I think we're probably coming towards the end. Probably time for one more, I would think. Any views on best balances to equity, such as property, commodities, cash, despite no return on cash? Well, this is the Tina angle. There is no alternative, and cash not yielding anything is a nuisance for so many investors. I'm fully aware of that, and it's a proper pain in the bottom for so many of you, particularly when inflation's at 2% and the base rates are at 0.75. If you're a real bear, you might think that locking in a guaranteed 1.25% loss on your cash in real terms is a better deal than owning equities you think are going to go through the floor, or bonds that you think are going to go through the floor. But again, nobody really, I think, would feel comfortable going 100% cash, i.e. selling your portfolio now and buying it all back later, because there's two decisions to make: when to sell, when to buy. None of us have got a crystal ball. None of us are going to get it right. And you're going to incur an awful lot of expenses and possibly tax. And frankly, you want to keep trading expenses down, commissions down, and you want to try and keep, you manage your tax through your personal allowance and using tax-free wrappers as are appropriate for your particular needs. But yes, you can flex cash, increase the allocation if you're getting nervous, because it gives you optionality. If the world does go to hell in a handcart or valuations get cheap, you have got cash. You can be the wise man or wise woman who's there to step in and pick up those bargains when everybody else is panicking. So having cash in your portfolio is useful, pays you fees, hopefully which you're keeping to a minimum, and it gives you optionality. If things do go wrong, you can benefit from pessimism, because pessimism, nobody likes it, but what it does, it brings cheap prices, and it's cheap prices that provide the best returns. So having some cash kicking about is always a good idea. How much, again, is up to your personal financial circumstances, but it's never a bad thing to have some lying around. But going 100% liquid and then going back again it is just going to be, I would imagine, on balance for most people, too cumbersome, too expensive, and frankly too fiddly. But yes, flexing and calibrating your allocations according to your worldview is I think, no bad thing, providing it doesn't lead you into the trap of overtrading. So thank you very much for your time, everybody. I really, really appreciate it. I hope that was helpful. I don't think my breathing was too bad after that cold, which the gentleman very kindly donated me this week. I think he was a gentleman. We really appreciate your time and support. We look forward to doing more of these as the year goes through. Watch out for the feedback form. If it hasn't appeared within the next hour or two, it may have slipped into your junk folder rather naughtily. We do look forward to hearing your feedback, good, bad, or indifferent. And watch out again for the video of this on our website in a few weeks' time. Thank you, everybody, and all the very best for this year.